Hello guys, you welcome to this particular lecture where we are going to be talking about Forex terminology, and we are going to be looking into 20 most used Forex terminology. And I believe that you need to know this if you want to become a Forex trader. So let's start with number one. The very first terminology that we are going to be looking at today is currency pairs. You need to understand that currencies in the foreign exchange market are traded in pairs. You cannot trade a single currency. You cannot trade dollars on its own. You must trade it along another currency. So a currency pair is just two basic currencies joined together that will form a pair. So a currency pair is two currencies that will join together to form a currency pair, which is being traded. So for example, we have Euro USD, which is a currency pair. And in a currency pair, the first currency is always called the base currency, and the second one is called the quote currency. So in this example, euro is the base currency, and the US dollars is the quote currency. The next one we will be looking at is exchange rate. You need to understand that the currency pair has to be traded based on the exchange rate. So a difference or in the exchange between the two currency will form what they call the exchange rate. So the price of one currency in terms of another, indicating how much of the quote currency you need to get or to buy the base currency. So that's what we call the exchange rate. So the next term here is the bid price. The bid price here is definitely the price at which a trader can sell a currency pair. So the bid price is the price at which a trader can sell a currency pair. So we also have what we call the ask price. The ask price is actually the price at which a trader can buy a currency pair. So the ask price is the price at which we buy. The bid price is the price at which we sell. So the next one is the spread. The spread is definitely the difference between the ask and the bid price. So the difference between the ask and the bid price will form the spread. Let me explain to you something very quick. If you go to the bank right now and you tell the bank that you want to buy, let's say, 1 USD, and they tell you 1 USD is equivalent to 500, this is the price at which the bank is selling 1 USD to you. If you come back to this very bank and you tell them that you have 1 USD and you want to sell, they will tell you that they are going to buy it for, let's say, 490 francs, for example, to get your 1 USD. They can never buy and sell at the same price. So there must be a difference between the buying and the selling price. And the difference between the buying and the selling price is what we call the spread, is the cost of the trade. And that's what they will benefit. So they will benefit that variance, that margin. So it's a spread. So the brokerages, the forex brokerages that you trade with will be charging you something called the spread, which you are going to be paying, and it's the difference between the ask and the bid price. So it's very easy to understand that way. So the next thing is the pips. So what is a pip? The pip is the smallest price movement that a given exchange rate can make based on market conversion. So the pip will be the smallest distance covered by price. We're going to learn about it. So we are going to say the market has moved 10 pips. The market have moved 20 pips. Like you move from Douala to Bamenda or from Douala to Yaoundé. The distance will be measured in meters. But if price move, it will be measured in pips. The next thing is the lot size. The standardized trading size or standing lot size is actually the measure. Let me just explain this way. The lot size will help you to understand or how much you are going to get per pip. So the pip, let's say the market move 2 pips. Your lot size can determine if per pip you are making $1 or $2. This is a simple example. Let's say a lot size of 0.1, it signifies $1. So if the market moves 10 pips, to calculate how much you are going to get, you multiply the lot size times the pips value to get how much you're going to make. So if my lot size is 1, for example, it means $10. So to know how much I've made for the trade, I will take $10 multiplied by the amount of pips that the market covered. So you are going to be using the lot size and the pips to know how much you have made for a trade or how much you have lose in a trade. So the lot size is very important. You are going to learn about it. You are going to learn about lot size. You're going to learn about pips in the previous videos. Sorry, in the videos that are going to be coming after this. You're going to learn about those things. So when you hear a forex trader talking about long position, it means that the trader is buying. So anytime you hear about long position, it means buying a currency pair with an expectation that its value is going to rise. When you hear about sell position or short position starts for selling a currency with the expectation that the value is going to fall. The next terminology is margin. Margin is simply the amount of money required to open a leverage position. So margin is like the capital that you have, that opportunity, the money you have in your account that you can use to trade. So the next thing is leverage. The ability to control a large position with a small account size is leverage. So in forex trading, there is something called leverage. And how will leverage help you when it comes to forex? Leverage comes to increase your capacity to earn. So let's say a leverage of 1:2 means that you can use one thing to buy two things. 1:10 means you can use one thing to buy 10 things. So if you have 1,000 francs and your leverage is 1:100, it means that you can use that 1,000 to buy something that costs 100,000. So that is the meaning of leverage. Leverage comes to increase your capacity to trade. So today, most forex trading is done with leverage. So most forex accounts have leverage that permits you to use that small $100 to earn big money. And also, leverage has advantages as disadvantages. We'll come to that again. Another terminology is called margin call. The 12th terminology is margin call. Margin call normally is, I can say, a request from a broker for the additional fund to cover potential lots. So when I say you have a margin call, it definitely means that you have a stop out. You have lost all your money. Let's say you have $10 in your account. You place a trade and you are going negative $9. That means you are almost losing everything you have. So you are getting closer to your margin call. So if you lose all the $10, then you get what they call margin call. So the next terminology is stop loss order. So a stop loss order is a setting that you can set to let the brokerage know that if you are losing money and you get to this point, let that trade stop. So let's say I am buying at 500 francs and I'm predicting that price is going to go to 700, but I will set a stop loss at 400 francs. So if the market doesn't rise and is rather falling, when it gets to 400 francs, let me go me out of the trade so that I shouldn't get a margin call, so that I shouldn't lose all of my money. So this will be called stop loss. The next terminology is take profit. Take profit tells you like a point on your chart where you want to take the profit you've made. So let's say I enter at 500 and price is going up to 700. I can say that at 600, let me go with my profit. So when you are setting this value, this will be called take profit setting. We are going to learn about all of these things that I'm talking about when we will be teaching you how to use the MT4 application. The next one is the base currency. The base currency is the first currency in the currency pair. The quote currency is the next terminology, which is the second currency in a currency pair. Now, risk-reward ratio, the ratio of potential profit to potential loss on a trade. When you talk about risk-reward ratio, you are entering a trade, you have $100. Your stop loss is $10. Your take profit is $20. So your risk-reward ratio is 1:2. So you are losing $10 to get double of it, which is 20. So risk-reward ratio just tells you how much you are willing to lose and how much you're willing to get. Now, my next terminology is fundamental analysis. Fundamental analysis is one of the most important things that you're going to be knowing when it comes to Forex. So we are going to be doing two types of analysis, fundamental and technical. So fundamental analysis does with what? Analyzing economic, social, and political factors that may affect the currency prices. So as Forex traders, we need to understand economic, social, and political factors that could affect currency prices. And the next terminology here is called technical analytics. It has to do with analyzing historical price chart and trading volumes to forecast future price movement. So listen very well. Analyzing what? Price chart and trading what? Volumes to do what? To forecast future price movement. So these two types of analysis is what we are going to be doing most often. The next terminology is what we call liquidity. The ease with which an asset can be bought or sold is called liquidity. We are going to learn about other terminology like volatility, which is actually how fast price can change or how fast price changes is called volatility. So I will include in the next video that we are going to be getting. So in the next video, I'll actually include some new terminologies for you to get, but I've actually talked about the most important ones. So these terminologies are what you need to know if you want to become a Forex trader. So friends, I hope you've understood. If you have not understood anything, please replay back the video over and over and over again. And remember, we are students always.